It's time for the Personal Finance Corner. Faye joins in. Faye, what's up for discussion today?
We're still looking at the tax quarter, so we're going to analyze every possible investment option to save on tax. And let's look at the Rajiv Gandhi Equity Savings Scheme that gives you a mutual fund option this year. Let me bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you for joining us. Well, we have an additional option, and this is for those of us who've never invested in equity before, the Rajiv Gandhi Equity Savings Scheme through mutual funds. Now, there are about 20 funds to choose from within the scheme. How should we go about choosing a fund from this list?
Of course, there are 20 funds, but they are all similar. Most of the options available are either Nifty or Sensex index funds or ETFs. So when choosing an index fund, the only thing you should look at is how good is the tracking error, how closely it is able to track the index and the expenses. So on that standpoint, go by expenses. Of course, there are 2-3 other promising options or a little different than pure Sensex or Nifty trackers, which is the Nifty Junior Index, which is goes beyond the top 50 or 30 companies, and the Motilal Oswal M50, which is also a little unusual by its weightage.
Well, Dhirendra, for investors who fall in this category, so obviously first-time investors who might be a little risk-averse, which of these funds would you recommend for someone who's investing for the first time?
I would say that Rajiv Gandhi Equity Scheme is not a great vehicle in a sense that the investment options available are all equity. There is no balanced option, or there is, these funds can't be 20-30% into fixed income by design. So from that standpoint, it is bound to be an all equity fund. But for investors, if they are coming for a few years, I think the risk can be mitigated with time. And if you are a conservative investor, the most conservative option available to such investor will be the Nifty tracker. But if you are looking for a high performance fund and you can withstand the volatility a bit, and anyway you can't pull your money out for 2 years. So for those investors, I think the Nifty Junior Index is a very promising fund.
Alright, so the Rajiv Gandhi Equity Savings Scheme available to those of us who've never invested in equity before. Dhirendra, we have a question that's coming from one of our viewers. Rishikesh has written in, he's 31 years old, he's been investing in mutual funds over the last 6 years across ELSS, large cap, mid cap and fund of funds through SIPs. Now he recently also opened a PPF. He wants to know how he should allocate his money to that PPF and the equity. So debt versus equity in his portfolio, how should he make that differentiation?
If you are investing for next 15-20 years, you actually don't need debt, but to provide stability and to be able to periodically rebalance your portfolio, which means realizing gains from equity when equity goes up, or moving your money from fixed income to equity when market is depressed or the market is not doing well, and that can be done with at your level by having a defined allocation, which means and for somebody in your age investing for next 10, 15, 20 years, I would say that you should have fixed income, but that should be a very nominal part. I think 15-20% allocation